Testing 1, 2, 3. Yep, we have sound. If you want to communicate with me, it's just a matter of going to the chat, which is over there or down here, depending on whether on a desktop or a mobile device. Looks like we have a few people here so far. Alrighty. Death Wish coffee. Okay, so why don't we get started? Of course, all of this will be edited and recorded or archived on the website under the members area. So if you miss any of it, you can go back there and check it out. And again, if you have anything to say, you have any particular questions, put them into the chat. That's what this session's all about. It's all about communicating, making sure everybody's on the same page. So I know that there are a number of new members. Well, there's always new members. The membership is growing and growing and growing. I think we have something a little over 500 members now. The members that are more experienced with the service don't usually come to the live event. It's usually the newer guys and gals. And but I would say that out of the 500, at least what I've seen, about 250 of the people actually watch this event. I'd like to see if I could get a way to get them more involved and participate a little bit more. I think it would make for an overall better experience for everybody. All right. So this past week, let's do a little bit of a review of what happened this past week. We had a pin trade, a good trade, and not a losing trade. It was ultimately never really fulfilled what we thought it would, but there was certainly a chance to make profit in during the trade on Friday. Now, your experience may have been different. However, I think that most people got into the trade after I did, which means that they got a better price. And if you got a better price and you didn't take profit when we had the opportunity, there were actually two separate opportunities to take profit on Friday's trade. There was one early on the day, and then it pulled back, and then it moved up again, and then there was another one a little later. And then it pulled back again because it really looked like it was going to continue up and then move into the T1 zone. But it didn't. And so then it pulled back. Now, if you failed to take profit on either one of them, either one of those opportunities, then that's really what I'd like to talk about. All right, Dennis wants to know, how would you like you to explain how you choose your strikes? Well, that's really very simple. It really is. So let me just review the trades, or just go over what some of the problems were and why some people profit when other people don't. And the biggest reason people don't profit is that they're always waiting for like the perfect opportunity to get out. And the perfect opportunity never comes. Well, it does once in a while. And you'll know those opportunities. However, if you're looking for that perfect opportunity every time, every Monday, Wednesday, and Friday, and you're waiting for it, then you're not going to profit that often, or you're only going to profit maybe 50% of the time, because that's about how much or how many times that it's maybe a little bit more, maybe 60% of the time that we actually end up inside of the profit tent of the butterfly that we choose. Now, you may say, well, isn't that what the whole thing's about? No, it's not. The purpose of this is to put us into a position where we can collect profit at any point in the day. And the earlier the better, as quick as possible, get out. There are some days when it becomes excruciatingly obvious that we are going to be moving into the profit tent, and that's where we're going to be spending the majority of our time during the day. Then there are other days, which I think are probably maybe 50% of the time, at least in the beginning, there's a question on whether or not we're going to ever make it into the profit tent. But what is absolutely for sure is that during that time, while it's skirting the edges of it, the P&L is such that you can take a substantial gain. A substantial gain, like 50 to 150, sometimes as much as 200% without ever entering the butterfly wings or profit tent. And all that profit tent is, by the way, is what the P&L will look like at expiration. It has nothing to do with the current time. So if that's what you're waiting for, what you're saying is that I'm waiting for something way further in the day that I hope is going to happen. That is the wrong-headed think. Absolutely the wrong-headed think, because the only thing that really makes a difference, the only thing that matters in this trade is the current P&L line. And on Thinkorswim, that's that purple line that is continually growing throughout the day and then eventually will fill up the butterfly. It's the only thing that matters. Do I have to say that again? I'll say that one more time. The only thing that matters in terms of taking profit and our strategy is the current P&L line, the purple line, and how it grows, and where it is at that time, and whether or not we're in profit or not. It's the only thing that matters. Everything else is just a pipe dream. If you take it that way, then profiting becomes super easy. Really easy. If you're used to going after, say, 5 or 10% of the risk that you take on by putting on an iron condor and hoping that it will stay somewhere inside of that profit tent of the iron condor, and then you're thrilled to take 5 or 10% of the risk, right? You're like, man, we made 10% today. That was like a winner. Well, 10% for us is butkus. Our smaller wins are 50 to 75%. 5 to 7 times larger than the perfect trade on the other way to trade 0 DTE. And our average is about 150%. That's 15 times larger. And if you're not sitting there taking those profits when you've got 50, 75%, then you're doing something wrong. You're waiting for this big kahuna. Now, if that's what you want to do, if you think that should be the strategy, then fine, then do that. But I'm telling you that you're going to be frustrated. It's better to win often and win relatively large. I mean, winning 50 to 150 to 200% is large. It's not 800 or 1,000%, which we will get every once in a while, but it's still large. And if you're worried that you're not going to get that 500, 800, 1,500% return, that is a high quality worry, I guess. Why worry that you may not, or you may miss out on that when you can get regular, substantial profits almost every time we go out? Makes no sense to me. I don't know how to communicate that to people. So as an example, now I understand with a smaller account, you're hoping to make those leaps and bounds. But the fact is that most of your wins with a small account are going to be those small scalping trades. We get into the trade, it price pops up, we have a 30, 40, 50% return. I would take it. Right? I would take it. Then price pulls back. This is what normally happens. Price pulls back, and then you're out of profit again, and then it might move up again, and it only achieves maybe the same kind of profit that it had before, and you say, okay, maybe this is the time, and I'll wait. And then it pulls back again. This is exactly what happened on Friday, by the way. And you miss out. You miss out on let's see, what did I have? I achieved a 75% return. You miss out on a 75% return. Why would you miss out on 75% return on the money that you put up at risk? With a small account, your goal is to turn it into a bigger account so that you can have more flexibility with how you place your positions. Your number one goal is to build it. The best chance that you're going to get to build your account is to take those quick wins. Every once in a while, price is going to move very strongly into the butterfly, and even with a small account, you can hang on for a little bit and take more chances because you're deep into the butterfly. So now you have an opportunity maybe to make much more than, say, 50, 75, or 100%. You'll know those times. They only happen about 15 to 30% of the time. The majority of time, excuse me, you're going to make quick, substantial profits. You have to really kind of condition your mind that that's what you're going after. All right. Now, I had two accounts going. I have two accounts going all the time. And quite frankly, with the smaller account, which is the reference account for the service, I don't pay as much attention to it as to my big account. And so I tend to not be as in tune to take those quick profits on it. And that small account sometimes suffers for that. However, on my big account, I did do that, right? I put on a trade on my big account, and I made like a little over $3,000. I had 10 positions. It went up there. I grabbed the trade. I grabbed the profit right away. The small account, I got much less, and because I wasn't paying attention, it's not that it doesn't mean as much to me. It's that I prioritize on, which account that I'm watching more closely. Plus, I'm dealing with questions and everything else. But if I were only dealing with just the small account, man, I would be taking those small profits. So that's really important. All right. So Dennis is asking, how do I choose my strikes? Well, let's go through how we actually choose a trade. And so what I'm going to do is maybe illustrate this a bit. But let's first of all go through what the process is. So in the beginning of the day, And so, first of all, let me say, in general, what we're trying to do is we're trying to create a butterfly spread as wide as we possibly can to where we think price is going to spend the most of its time during that trading day. That is our ultimate goal. We're not trying to treat it as a market neutral, because we won't get the kind of risk to reward. So besides creating as wide a spread as we possibly can, we also simultaneously want to create an asymmetric trade. And we have criteria for that. Do not take the trade unless you can set up your butterfly with it, whatever width it is, at least 1 to 5 risk to reward. So when I say those two things, we're going to create a butterfly. We want it as wide as we possibly can, and it has to be at least 1 to 5 risk to reward. Now you're asking, well, how do I choose the strikes? Well, I just told you how I chose the strikes. Right there, for the most part, right? Now I may adjust that a bit. I will adjust that a bit based on the volume profile, structure, and the underlying market and the energy that's in the market, how much volatility there is. But a lot of that will kind of give me the ability to create a wider trade or not. So when we have a higher level of volatility, the butterflies become inflated with premium. That means that the spread that itself sits higher on the P&L line. When it's inflated, it always sits higher, which means that we can make it wider and push it further out. By doing that, we can create a better risk to reward and increase our probability of profit by making it wider. When we have low volatility, we have to make it narrower and have it closer to our current position in order to still maintain that 1 to 5 or better risk to reward. So that there is no other magic than that, other than that's how I choose my short strikes and the long strikes. Now, in general, though, we start off by doing an analysis of the market structure, figuring out where all the target zones are and where we currently are. And because we understand, if you have taken the course on volume profile, that the volume nodes are kind of like targets, because price will go to the volume node and tend to consolidate around there. And the volume wells, or the lack of the volume nodes, they are trending areas. Price either scoots across it or goes into it and gets rejected. So we know this behavior. Those are the two fundamental behaviors. It's trending and consolidation behavior. We know coming into the market, either we're already in a trend and it's continuing that trend, maybe from the overnight session, maybe from the past week and a half of trending market. We know which way markets are going. We analyze everything that is going to be an input to that market that day. We're looking at the previous trend, the overnight trend from the Globex session that opened up, at 3 a.m. We're looking at the economic reports that come out between 7 and 9:30 in the morning. We're cognizant if it's a Fed day or if there's some political figure going to talk or a Fed governor going to talk. We know all this stuff. We watch the results, and then we see how that affects the market, and we can see that if there's energy put into the market, we can tell if it's going to be a bullish or a bearish day. We can also tell relatively how bullish or bearish it's going to be. We've already analyzed the market because we've done the market structural analysis with the volume profile. So now we know if price comes into this market and it's breaking out of, say, one node and into a volume well, there's a pretty good chance that it's going to move up to the next volume well. Well, that becomes our sort of de facto target. Where on that volume well, it doesn't really matter. It could be at the edge of it. It could be in the middle of it. It could be at the far edge of it. All I care about now is, now that I have that target, I want to create a spread as wide as I possibly can that gives me that 1 to 5 minimum risk to reward. So I've just told you now how I choose my strikes. We analyze the market, the market structure, get the energy, figure out where it's likely to go, place a trade that covers that spot, with the short strikes over the target, and make the spread as wide as we possibly can, and create an asymmetric trade that's at least 1 to 5 risk to reward. Any questions on that? I don't know how much. It's a lot of moving parts and everything and what we have to do, but whoever said that trading is going to be easy? You have to make your best guess on how much energy is coming into the market and where it's likely to go. We've analyzed the structure. We have a good idea. Then place a high probability trade with a great risk to reward. So I've said that now about maybe four times, maybe 5 times. Hopefully it's sunk in, right? We analyze the markets, analyze the market structure, get an idea of where price is likely to go. Once those things happen, we get kind of a bullish or bearish bias, direction and magnitude of that direction. And then we create scenarios about where we think it's going to go. Every morning, I do this every single morning. I create that analysis for you. I put out all the information. I create as well a few scenarios. I say, okay, price could go up to this one and then pull back, or it could go halfway into this volume well and pull back, or it could go through that node into the next node. So I come up with a few scenarios because we don't really know what's going to happen. We really have no way to know what's going to actually happen. Now, once I've created these scenarios, I try to come up with at least 1 or 2 trades that will cover those scenarios. Again, using the same thing, I want it to cover, where we think it's going to go as wide as possible with the greatest risk to reward that we can make. I think I'm going to sneeze. There we go. Let's see. Lawrence says, so enter, wait, and get profit. No stop loss. No, why would we have a stop loss? Why would we ever have the whole purpose of the asymmetric trades, the small risk, very small risk, tiny, tiny, tiny little risk, is so that we never have to do a stop loss, ever. Also, we never have to get all stressed out and anxiety-ridden over our trades either. If you are getting anxiety-ridden over the tiny risk that you're taking, then you're taking way, way too much risk. And you need to scale back. End of story. I'll say it again. If you put on a trade and you're getting stressed over the tiny little amount of risk that we take. So for instance, we put on a trade and it has $100 of risk and a potential profit of, say, $800. If $100 on a trading day is going to stress you out, then you need to either skip that day or find a way to put on a trade that's going to have less risk. But let's say that you have a $5,000 or $6,000 account, and you say, well, I don't want to just put $100 down. I want to put $1,000 down. 5 positions. Of course, you're going to get stressed out if it goes against you, because that could be 20% of your account. If that's happening, you're trading way too much. Way too much. It's so much better to trade super small, make those small incremental wins. So let's say you have that $5,000 account, you put up one contract, one position, you were able to collect 100% return on your risk, so you collected $100. That should make you happy. Go on to the next day. Do it again. Do it again. Do it again. If you did that every week, each time, let's say, and you win 2/3 of the times, you're going to more than double, close to triple your account at the end of the year. If you just do that, taking small wins. Think about what I just said. By taking small wins, and even if you're only winning 2/3 of the time, and you never hit a big kahuna, you're going to double or triple the size of your account in the course of a year. If you only take small wins and you do it consistently, you're going to double or triple the size of your account in the course of a year. No, because a trail is a stop. There are no stops, Lawrence, at all, period. End of story. No stops, ever. It's the worst possible thing. Just no stops. No trailing stops, nothing. Bullshit. That's not what we're after. There's no reason to do it. If you're thinking stops, then you're trading too big. Put this into perspective on how other people are trading 0 DTE. Most other 0 DTE practitioners are putting on iron condors with 5 to 10 delta spreads. That means that they're putting on 90-95% probability of profit trades. Each wing is risking, let's say it's just a minimal size, each trade is risking $600 to $1,200, trying to make $100. Now, they're not really trying to make 100. What they're really going after is if they reach 50% of that 100, because they have to set stops for fear that they might challenge those wings. And those stops are usually 2 to 3 times the total risk that they take. They have to do it. Otherwise, they could potentially wipe out. Now, they don't have to. It's just a dumb way to do it. But they do it because they're afraid of wiping out weeks or even months of profit. And so instead, they're going to put on $1,000 risk to make $50. If they make $100, that's like a glory day. You know, they made a max profit, and it's like, whoa, unbelievable, to make 10% of their risk. As soon as they go into a trade and price starts moving left or right, gamma risk takes over. Their account goes into big red, potentially 2, 3, 4 times the risk that they put on. They're down $200, $300, $400, and they're sweating bullets the entire time. With our trade, we're not sweating bullets. We put the trade on. Let's say it's a max risk of $100. We go down 30, 40, 50 bucks. It's like no big deal. We know that we could lose the $100, but that's okay. That's all we could ever lose. We're not at risk of losing $600, $1,000, $1,500. And particularly the difference in what we could lose versus what we're going after. We're worried about losing $500, $600, $700 in the other way of doing 0 DTE, so that we can make $25, $50, $75. Compared to us, where we're maybe losing $30, $40, $50, maybe lose $100, but we might go after $500, $800, $1,200. It's a completely different mindset. By 2 orders of magnitude. You should never be thinking about stop losses, ever. You should be thinking about how you're going to get profit. See, the problem is that you see that big potential profit, you think that that's what we're going after? No, we only make the big potential profit so it makes it easy to get the really good profit, returning 75, 100, 150%. Hopefully that makes sense. We create the very large potential profit. That way, the premium decay, the theta decay, is working in our favor. It increases faster at a much faster rate. Imagine the difference between the way other people do zero DTE. They're looking for a total of $100 of theta profit. So in the whole day, they have to wait a whole day for it to go to 0 to 100, right? In your day, you're waiting for it to go from 0 to 1,200. So regardless of whether or not you're smack dab in the middle and able to get there. So in other words, in your day, profit is growing much quicker. So gaining smaller as a percentage of the total is still 5, 6, 7, 10 times faster than what they're going after. Maybe that helps put it into perspective. So we often achieve 50, 70, 100% return very, very quickly. A lot of people are like, well, I want to wait on this one, or, maybe I'll go for the big one this time. It's fine. But there's no guarantee that we're going to stay up there. You could move out and then lose and come to a max loss of the $100. Not a huge loss, but still a loss, because you refuse to take the relatively small profit compared to what our risk is or what our potential profit is. It's relatively small, but compared to what other people are going after, it's like 5 or 6 times what they're going after. But you're still refusing. It's this relative game that just blows my mind. More willing to take huge risk to go after tiny little profit and go through unbelievable anxiety than take very small risk, go after huge profit and zero anxiety. So any anxiety that you bring on in our method, you're bringing on to yourself, because you think that your goal is to go after the 1,000% or 1,500%, and that if you don't get that, somehow you're a loser. When you could be sitting there doubling or more than doubling your risk that you put on every time you go out, and not putting much of your money at risk. It's a huge difference between the way they do it and the way that we do it. It's just, and I'm sorry to harp on this, but it's just, it just drives me up a wall. You could be taking a small account and you could be double or tripling it. Now, I proved this last year when I first started the service. I started in April, and from April to December, I went from a $3,000 account to an just a little over $8,000 account, about $8,400 in 9 months. All right, so almost tripled the account in 9 months, just taking tiny little profits. Every once in a while, we got a big profit and it helped, jump us up. That's the way to do it. Now, I made a colossal error in January because I was getting frustrated with the market, and I put on way too much risk on that account, that small account, and I wasted a bunch of money in that account, which was a hugely bad mistake. However, at the same time, I made a crap load of money in my big account. So those things happen. But let me just say this, that once you've gotten to a larger size account, you're going to have a lot more flexibility in the way you approach the market so that you can get yourself into those bigger profit zones more regularly. But when you have a small account, you can't afford to do that because you need to concentrate on growing your account. When you have a larger account, like, I'm working with like a $300,000 account on my large account, I can put on, 10 positions at once and even add another 5 positions if I want to, but I don't. And then when I get up to, say, I've maybe 50% return or whatever it is, I've made $2,000 or $3,000, I'll take half of it off, or I'll take 3/4 of it off. If I take 3/4 of it off, I've guaranteed myself a profit, and I can let the remaining quarter run and see if it will go higher for that bigger return. So when you have a bigger account, you have more options. You can trade different strategies that allow you to get into the quick profit and then extend for the bigger profit. But if you don't have a bigger account, then you shouldn't be doing that. Just build it so that you can get to the larger size account so that you can employ some of these other strategies. And you really don't want to employ these strategies until you're able to put on at least three positions. And I wouldn't put on 3 positions until you have at least a $15,000 or $25,000 account. All right. All right. So I've explained, what is the difference between how we trade and everybody else trades, what our goals are for risk to reward, how I choose strikes, right? Which is something that we do every morning. Every morning I get into the 0 DTE analysis channel, which is a read-only channel for you guys. And I post the analysis of the day. And then I go to the talk channel and say, hey, there's the analysis. Take a look at it. What do you think? Then we talk about what's going to happen during that day or what's potentially going to happen. And then I come up with some trades that I want you to stage in the analysis. So I'll come up with example trades. They are not alerts. They are trades that I'm putting out there that I want you to put into your trading platform and fool around with them. Change the strikes. Make them wider. Make them narrower. Maybe choose the short strike, maybe a little further away, maybe a little closer. Because everybody's account is different. Everybody's capacity and tolerance for risk is different. And you're new to the strategy, so you need to be able to explore these things so that you can see how you can do these trades on your own. So I put out these example trades. Sometimes I put out 1, sometimes I put out 3. And I'll say stage these. That means, put them on your, if you're in Thinkorswim, it's very easy to stage them. You can stage all kinds of them and you can turn them on and off and see what the differences are and so forth. Then at some point, I'll say, I like this trade and I'll put it on. Does that mean that you need to follow me? No. Some people have already put on trades that they like. Some people wait to see exactly what I put on and they put on that trade as if my trade is the most perfect trade. And I'm here to tell you that my trades aren't always the most perfect trade. There are some people that are out trading me in the service. They've come up with their own strategy, their own ideas that are still following the same philosophy, same plan, but they do things a little bit differently and they get in at different times and they do great, right? Other people follow me and they do well too. Some people are afraid to do anything, and they just take a little while to get, I guess, their gear going. But it's not necessary that you copy me. If you're unsure, then don't throw money at it. Just stage the trade and watch it and see what happens. That's what I would do. When you start doing it over time and you've made, say after 4 weeks, you will have made 10 to 15 trades. After 10 or 15 trades, you should have some level of confidence in what you're doing, at least in the execution part, and a basic understanding of how I'm placing trades, how we're doing the analysis, and what to expect. And also being able to develop that confidence that we're not really anxiety-ridden over our positions because we're not putting a lot up at risk. What we're more concerned with is how we're going to grab the profit. So we're not doing risk management because the risk management is built into the trade. The risk is the risk. What we're concerned about is how much profit can we grab. When you have a small account, you take quick profits. When you have a bigger account, you can take a few more chances. When you have a much bigger account, you can come up with a strategy that allows you to take the quick profits and go for the bigger wins. All right? Hopefully all of this makes sense. Now, most weeks I go over a wide variety of scenarios. Just to give you an idea. Let's see here. So I'm going to go to So in previous weeks, these have been like all the different scenarios and workups that we do when we're going through. What I'm going to do is I'm going to talk a little bit about volume profile today. So the first thing that we'll do is we'll look at, let's look at this. This is something that you're going to see every morning. So every morning I'm going to put out a chart like this, and you'll see that there are parallel lines that encompass these nodes. What I try to do is I try to place the top line on the receding top part of the node and the bottom line on the receding bottom part of the node, where the node is falling off at its quickest rate, because that level is extremely significant. Those lines represent support and resistance depending on whether price is above or below them. Inside the lines, inside the node, price tends to consolidate. When it moves outside the node, it tends to move very quickly to the next node. And it will either move very quickly to the next node, or it will go halfway through to the point where the lowest point of volume is, like right here, and it will either move through it or it will get rejected and come back. That's the behavior that happens. So, for instance, for tomorrow, here we are. I've called them T0, T1, T2, T3, T4. They're numbered in the order that I think that price is likely to enter them. All right. So if we're in T0, that's like a no-brainer. We're T0. We're there. What's the next most likely node? I think we're going higher. So I think that at least for now, because we're on this kind of uptrend, we've pulled back a little bit. We're still in an uptrend. Some may wonder, are we in a downtrend? Well, we were in a downtrend up until about, the beginning of March. And then March 1st and these few days going sideways, I would say that there's a possibility that we're shifting here. So because we have a very deep, dark volume well below us. And also because there's more certainty in the market. The big sea change here has been certainty, by the way. The big sea change in terms of certainty of rate hikes over the coming year has been resolved with the Fed's meeting. Now, the only thing that's left is the Fed to actually implement their next rate hike. So that's probably why we're consolidating here, waiting for that to happen and waiting for us to go higher. Because right now, the market now knows that the Fed's going to do a bunch of rate hikes. Before that, they didn't know, so the market came down. Plus, there were war issues and other complications and so forth. But all of that uncertainty caused the market to come down. Now the Fed has they have announced that they're going to do rate hikes and how many and to what extent. And so now the market is a little more certain about its future, so it starts going up. But now we have the actual rate hikes that are supposed to come very soon in the next Fed meeting. And so we're going sideways, but more than likely in the meantime, I think any pullback should be bought up. So I think that tomorrow we're going to be going from T0 to T1. So what I'll probably do tomorrow morning, and before I'll make this decision, I'm going to take a look at the economic reports that are coming out. Let me just take a quick look and see what those are. What are the economic reports tomorrow? Economic reports for tomorrow. For the 7th. Wow, there are no United States economic reports, except for at 3 p.m. There is a consumer credit month over month. Other than that, there's nothing. So tomorrow, we have no economic reports. So we're really basing things off of whatever trend or wherever we're expecting to go. So it looks like what we're doing is we're in this sort of sideways channel. We're at the bottom of the channel, so we're probably going to go up. And then we'll probably go down, and then we'll probably go up. I think we're going to stay within this very large node here that's actually made up of 3 different nodes, T0, T1, and T2. That's what we're going to be doing for the next week or so until we get the Fed to come out. Now, I've also I've posted in the site what the Fed is likely to do, right? And what I did was I went to the the Fed Watch tool on the CME. Here, I can do that right now. Let's see if I can do that to show you. Let's change this. Safari. All right. This is the Fed Watch tool. The way this is calculated, there's a whole write-up on it, and I'll be providing the link. I've provided the link before. You can go back and look at some of the other instances of it, but this is a reading from all the bond traders in the futures market, and based on how they are buying or selling bonds, which are directly they are interest rates. Bonds are interest rates. They can tell how the market is anticipating what the Fed's going to do in the coming rate hike meeting. And they are 94.9% saying that there's going to be between a 25 and 50 basis point hike. And then there's a smaller contingent, that about 5%, that says that there's going to be no hike. So those are the odds in the market right now. So the market's pretty certain what's going to happen. So based on that, let's go back to the chart. All right. So based on that, we're probably going to go from T0 to T1, maybe even to T2 on Monday. All right. So let's zoom in on that a little bit. So there's T1 encompassing this node. Now you notice the nodes, they don't get as defined. That's because I've removed some of the data that builds them, but that's why we create these lines when I'm encompassing more data, so that we don't lose track of them. So there is a node there, a T0 node. I think price is going to go from here to T1. If you look at the price right in the middle of T1, it's about, I don't know, 43.75. Now 43.75 will probably be a good short strike for a good starting short strike for my butterfly. Now I might also think that, hey, it might be a really strong day, and maybe it's going to go all the way up to 4,400, which would be way up here in T2, which is also a possibility because that's what happened way back here on March 2nd. Went from T0 all the way up to T2. And then we came down. Right? So you don't know. We really don't know. Which way is it going to go? My best scenario is that we're going to probably do this. We're probably going to go from here to there. Let's see. I need an arrow. I think this is probably scenario number 1. This is probably scenario number 2. Something like this. There's another possibility that we come down here. Now notice that there's a real low point down here. I'm going to say that there's a right around there, right at this low point right there. That's a volume well with a really low point. There's actually 2 here that could provide support and to a move down. I think these 2 points right here and here, there's a possibility, if there is some really bad news that comes out tomorrow, that we could do something like that. Maybe even arrow. Maybe even go all the way to there. But I think that those will be bought up and they will come back. So here, I'm drawing all these scenarios. This is what I think is going to happen tomorrow. I think that these going up a much higher probability, given the fact that there are no economic reports. There's relative certainty in the market. Right now, we're just going to be moving sideways within this big, huge node until that certainty is, any uncertainty is resolved. So there's certainty that we're going to have rate hikes. There's pretty good certainty about what those hikes are going to be. That'll all be culminated on when they actually hike the rates. And then there will be some kind of Fed speak that will talk about it and about what their future plans or outlook is. And that may or may not jive with what the market thinks. It will either provide certainty or provide uncertainty. If it provides uncertainty, the market will drop. If it provides certainty, the market will go up. It's as simple as that. If it provides some kind of confusion, it could be interpreted one way or another, then maybe we go sideways. Don't know. So given this scenario here, tomorrow I'll probably come up with a trade. And that trade will look something like, well, I don't have Thinkorswim up here, but I'm probably going to pick either a short strike at 43.75 with 25-point wide wings, maybe up to 50 points if I can get the right risk to reward, or maybe I'll go all the way up to 4,400 and make them 50-point wide wings if I can get the right risk to reward. And one of the reasons why I'm willing to go that wide right now is because we're going to look at something else here. The VIX is super high right now. All right. There's the VIX. These green lines, everything inside these green lines represents our what we call the Goldilocks zone, the area where we like the VIX to be. We're inside here. We like the higher end of the Goldilocks zone more than the lower end, but we like anything inside here. Right now, these are ideal positions for us to make trades. That means that we can make really wide asymmetric trades with high probability. So there's a lot going on for us that's good in the coming days and weeks. There's also the potential that something could blow up. I mean, volatility is high for a reason, and that is mostly because of the war, and also inflation, and all sorts of other things. But in the face of all of that, if the Fed gives the market solid guidance into the future, the market's still going to go up. Sure, there'll be some volatility left over because of the geopolitical conflict, so we'll stay elevated. But at some point, even with the war, I suspect as we go up, this is going to start dropping. All right. Are there any questions on what I went over and that analysis? So you see how we're taking into consideration all of the geopolitical and geo-macro stuff that's going on in the world, trying to figure out where price is going. We look at the volume profile to get a market structure that will provide us a landscape that if there's some energy put into the market, this is where it's likely to go. We create some scenarios. We have an idea of how price will behave when it goes across those, and so I create those scenarios showing those arrows, and then I'm going to create a trade that will give us the kind of risk to reward that we want and falls in line and covers most of those scenarios. We create small risk with very large return for a very specific reason because, well, quite frankly, the philosophy, that's our general philosophy, is that those type of trades provide a much greater chance for opportunity. They give us better theta, in other words, better growth of what we're going after, and that is premium decay on the very last day of expiration. We do it specifically so that we can maximize the tremendous advantage we have of trading the very last day of expiration. That's why we create the asymmetric trades. On that last day, when you have the maximum premium decay, we want to create trades that have the maximum profit potential. All right, there's a question. Have the short daily reviews you talked about in the retro February 27th started yet? I started doing one of them. I got to start getting into the habit of doing it, so I haven't done them religiously. They will be in the What channel is that? There's a new channel for it. I need to come up with a format for it, you know. But they are in the zero DTE review. You'll see that I created one so far. All right. Sooner or later, I'll get into it. So I'll be doing them 3 times a week. You got to remember, every time I add another thing like this on, it takes away from me doing other things, and I'm one person running a service with 550 people, and so I'm trying to divide up my time. Plus, I get a lot of people calling me and asking me questions and so forth. So I'm doing my best to try to solidify that extra piece of information so that we can, at the end of the week, review those. But thank you for keeping my feet to the fire. Really appreciate it. Any other questions? No? All right. I'll give it a few more seconds. If there aren't, then we'll conclude, because we've been at this for an hour now, and that's as long as I want to make one of these go. When I edit it down, it will edit down to about 50 minutes. But I do want to thank you for showing up, and hopefully this has been useful. Thank you very much, Lawrence. And we'll see you all tomorrow. I will be looking at the market. The market opens up tonight at 6 p.m., the futures market. So I'll be checking out the market and trying to make a determination, and then refine that determination tomorrow, Monday morning. Okay? Have a great rest of the weekend, and we'll see you tomorrow.